Hi, welcome to the Whitaker-Myers Wealth Managers Question of the Week video. This week's question is all around, is your investment strategy outdated? Now, you might have wondered if your investment strategy is keeping up with the times as it relates to the economy, the markets, but maybe the times as it relates to your personal situation. And in today's fast-paced and ever-changing financial world, where things are constantly evolving, it's easy for your portfolio to become outdated even without realizing it. Now, at a basic level, of course, we will always want to stick to the core tenets of growth and income, aggressive growth international, as at least as it relates to investing in the stock market. But you can still tweak and energize your portfolio based on what's happening currently in the market. So let's dive into 5 key questions to help you assess whether it's time to refresh your investment approach. The first point is the biggest and the most important question, and that's going to be, are your goals still the same? Now, most of the time you're investing for retirement. That's the primary goal that most people are looking at. It's the goal that's out there for everyone that we all have to think about. We all have to put some time and attention towards. Otherwise, we're going to be relying on the government, which is well known for its ability, $35 trillion, to take care of us. And considering the fact that, again, we're $35 trillion and growing, although we have much, much hope for Doge and the work that they're going to do to stem a lot of this over government spending. At this point, it doesn't look like that's a very good bet to bet your retirement on them. So you need to save and you need to invest. And again, a lot of those investments are for retirement. The question you have to ask is, how close am I to retirement? Because that might mean some changes I need to make in my investment strategy. In my article that I wrote in 2022 called Bear Markets Normal But Not Fun, we looked at this. We looked at the average time it takes for a bear market to hit the bottom and the average time it takes for a bear market to recover out of that bottom. And the answer was the average was right around 3 years, but it could be a lot longer. And of course, it could be a lot shorter. Think about COVID. COVID was only 30 days to the bottom nearly, and then a massive quick bounce back up. However, most of the time it doesn't take that. It's not that expeditious. Think about 2022. That market was more normal bear market-ish, where it did take about a year to hit the bottom. And on the S&P 500, it took about a year and a half to get back to where it was, and much, much longer for the Russell 2000 and the MSCI EFA. So are you still investing with the same objectives you had when you were 30 or 40 and now you're 5 years from retirement? That might mean that your investment portfolio is outdated, and you need to take a look at that. You could be focusing on other things that you're investing for, maybe saving for a house. That is a goal that is relevant to when you think you're going to buy that house. Again, your investment strategy should reflect how close I am to those sort of things. It's obviously important to realign your investments based on where your goals are, where you're headed, not where you were, but where am I right now relative to those goals? And so that is a very big and very important question. You always need to ask yourself, are my goals the same, or how close am I to those goals? Point number 2, are you properly diversified? This is one of the major issues we see with other clients when they come to us, is they're unhappy with their investment strategy, and they're typically unhappy because they're not properly diversified. They were maybe all in growth and income. They were all in aggressive growth. They were all in international. We've even seen some people. And that's not the right mix typically to be a master of the middle. It's the right mix if you can pick the right category and be right all the time. If any of you find that person, please let me know so we can reach out to him and her and hire them. But typically that doesn't happen. So, an outdated strategy, a strategy that may need updated, is one that might have you heavily invested in one type of investment, one sector of an investment, or one region of an investment. Markets are always shifting. They're always moving. And the best category today is never the best category tomorrow. Maybe for a time it is, but not forever. That's why they make us say past performance is not indicative of future returns. And diversification is key to trying to manage that risk and staying ahead of market trends. Let me say that again. Diversification is key to managing risk and staying ahead of market trends. So if you're not sure, it might be time to revisit how you're spread out, and are you truly spread out into the growth and income, aggressive growth, and international parts of the market that we think a client should be allocated towards. How about point number 3? Are you adjusting for market conditions? Markets today are more dynamic than ever. and more dynamic than they've ever been. So you should review your strategy to account for today's economic environment. Things like inflation, interest rates, global economic shifts can have a big impact on your investments. So if your strategy doesn't reflect these realities, it could be partially holding you back. Now, this doesn't mean time the market or move in and out of categories or those sort of things, but we would say it's important to understand where the markets are at, what's happening, and have your portfolio reflect those realities. How about point number 4, and this is a big one, are you keeping cost in check? Of course, we know fees can erode your investments over time, but mutual fund expense ratios and trading fees have been going down and down and down and down. And if you're not paying attention to your portfolio, you could still be in a very expensive mutual fund when much cheaper options are available. Or if you're not paying attention to where you're at from an investment perspective, what custodian you have, you could be paying trading fees, whereas the Schwabs and the Fidelities of the world don't charge those anymore. So keeping your costs in check is a much easier thing to do today, but you do have to be paying attention and thinking about that. Modern investment strategies, including the ones that Whitaker-Myers pays a lot of attention towards, often prioritize low-cost options, such as ETFs, which are very similar to mutual funds, but they have lower costs, and they can still have a strategy built into them that tries to generate what we call alpha, excess return. So if I want to get the market, I can get that. That's very low cost and easy to do. And if I want to try to outperform the market, I can do that. And that, in today's world, is still a very low cost proposition there. So if you haven't checked your portfolio's costs recently, now might be a great time to look into that. How about point number 5? Are you staying educated on new opportunities? To the extent that you are engaged and encouraged by the new opportunities happening in our world, you can see that the financial world is evolving, and new investment vehicles like digital assets and alternatives are becoming more and more accessible to every investor, whether you're a retired investor, and there's things out there like private credit today, which generates a much higher yield. There's some drawbacks to the private credit side, but there are some pluses, or digital assets, which have becoming more and more mainstream and popular, and may even become more so under President Trump and the new SEC chair that he puts in place. You should, to the extent you're comfortable, you should explore those opportunities. If you're exploring them, that means you're at least becoming educated about them, and then you can make an educated decision. But if you stick to the same approach you've always known, then you're going to get the same result you've always got. And that may not be a bad thing, by the way. That may be something that you should do. We're just saying, hey, one of the things that you might want to do is be educated on new opportunities. And if you have a financial advisor, you should be asking them about these opportunities, because you want to know that they are completely and accurately informed. If they just tell you no, it's not a good option, but don't tell you why, that is not good enough. It's okay that they tell you no, but they better have an educated and researched answer to that. Or if they say yes, they better have an educated and researched answer to that. Staying informed can make a big difference in your portfolio's returns over time there. So how did you do when you looked at those 5 areas of your portfolio to see if it's outdated? If you're unsure about any of these questions, it might be time to sit down with your financial advisor and ask them these questions to see if your portfolio needs any sort of tweaks, updates. Again, at the core, we say don't make a lot of changes. Keep yourself positioned in the growth and income at Growth International. But there may be some things that have left your portfolio outdated, and that's when it's a good time, if you're unsure about that, to get your portfolio checkup. So thanks so much for watching this week's video. If it was helpful to you, would you do us a favor? You can do us a favor by hitting the like button and the subscribe button, as well as share the content if you liked it there, because we are constantly trying to improve your life by giving you tips on building wealth and helping you achieve your goals, because ultimately we know that when you follow the baby steps, you get to a position where you've lived like no one else, so later you can live like no one else, and for yourself, for your family, for the kingdom of Christ, and all those around you. So thanks so much. We'll look forward to seeing you on next week's Question of the Week.